Good afternoon, everyone, and welcome to our session on planning for your retirement. My name is Ted Wheatley. I'm a CPA in the financial services industry, and I'm also a volunteer with CPA Canada Financial Literacy. So let's look at the agenda for this afternoon's session. First of all, we're going to talk about why do you need a retirement plan. And I think that one's pretty obvious. I mean, you could, wing it into your retirement, or you can plan for it because it's something that's going to come at some point. And for a lot of you, it's something that's going to last for maybe 30 or 40 years. The next part, of course, is the most famous question people ask me, which is, how much do I need to save? Everybody wants to know. Now, when I give you the answer, you may not like it because it's going to be you need to save as much as you need to spend in retirement. We'll talk a little more on the details of that, but that's sort of the answer to that one. We're going to talk about a lot of retirement saving strategies. We'll also be focusing on several sources of retirement income, such as registered and non-registered savings. Now, registered, RRSP, TFSA, non-registered, it's your own savings, maybe stocks and bonds. We'll also talk about government benefits, Canada Pension Plan, Old Age Security, and we'll talk about company benefits, such as a defined benefit or a defined contribution plan. We're going to talk about, at the very end, I'm going to give you 10 tips that are 10 important topics about retirement plan that you can take away and implement yourself. And then we're going to talk a bit about some tools and resources you can use on your own at the end of the seminar. And obviously, I will take questions. So let's talk about our first topic on the agenda, which is why do you need a retirement plan? As I sort of said, why not just wing it? Well, let's talk about some reasons why that wouldn't be the case. First of all, this generation that you're now in is one of the healthiest and longest living in history. And in fact, some statistics show that, if most people who reach age 65 without serious health issue, most likely can live for another 20 years to 85. And in fact, there's anybody in the room who's between 55 and 65 today, chances are you're going to live to 90. So we are a generation that lives longer. And what does that mean? That means we'll be in retirement longer, and we have to account for that. A second reason why you need to have a retirement plan, of course, is government benefits, while they are useful, aren't necessarily sufficient to live on, and that's Canada Pension, Old Age Security. So there needs to be other means to support you through retirement. There are changes going on now in the financial landscape. The biggest one is company pensions. Only 40% of Canadians have company pensions, and of those, many of those now are defined contribution pensions. Quick difference, defined benefit pension, the company does everything for you, and you get a defined benefit when you retire. Defined contribution is more like your own savings. You have to pick the fund you put it in, a little more work on your side, and that means then you need to do a little more work in your retirement plan. And the last reason, of course, why you should have a retirement plan, statistics have shown that people with financial plans, people that use a financial planner, tend to have more assets saved, more successful, more comfortable about their retirement savings plans. So those with a long-term financial plan are going to get through retirement less stressed. And in fact, there are some statistics that show 5 years before retirement, a lot of people are concerned about, will they have enough money? Interestingly enough, 5 years after retirement, people are more concerned about their health and not as concerned about financials because they put things in place. Now, the first step in retirement planning actually is not a financial step. It's actually asking yourself some basic questions really about what your retirement's going to look like. What are you going to do? Not all a retirement is the same. Some people have a very quiet retirement. Some people do a lot of traveling. So you need to ask yourself some basic questions. First of all, how much do I need to save just to live comfortably, pay the bills? How much do I need to save to meet other financial obligations? I may have dependent children, adult children when they're older. There may be other things I need to do. How much do you need to save to just maintain the lifestyle you have, or quite frankly, improve it? You may have some goals in retirement that you want to do that are going to cost more than maybe when you were in retirement. And then most importantly, what do I need to save to achieve some of the goals and dreams I have? Because when you define what you want to do in retirement, that's going to involve things you want to do. That translates back and then to how much does that cost, and then how much do I need to save? Some more questions obviously to consider when you're considering, about retirement. One of the most important ones, and of course this is a step one, is when do you plan to retire? It's different for a lot of people. I know people who wanted to retire early, age 55. I know people who would like to work as long as they can. So first step you got to do is, when do you expect to retire? Now, it's not always your choice. Two factors that can make a difference of when you retire. One is health issues. People sometimes have to retire early if they have serious health issues. Others, corporate downsizing, they may lose their job, and again, it's unexpected retirement. So always plan to when you want to retire, but sometimes you always need a plan B in case sometimes you retire earlier than you expect to. Another point to look at is, what is your current net worth? Obviously, if retirement is going to cost a certain amount of money and today you have a fair amount, well, that makes a difference in your plan. If you haven't started saving yet, that may make a difference as well. So you want to assess where you currently are with your own net worth. How about your health and your life expectancy of your family? Some families have where the men don't live as long, and some people have where the women live a long time. My mother's 90, my grandmother lived to 102. The men in our family, not as fortunate, unfortunately, but the women live longer. And that's important. You do need to sort of know how long have your family lived, how long maybe you expect to live. And this is, I think, very important for women, who generally tend to live longer than men and could live, as we're seeing now, over the age of 100. How about your family situation? Maybe couples with kids. Some people have children that are still dependent in retirement. They have to take care of them. So that's another factor to look into. And then what about your legacy or charitable giving? People have plans of what they want to do towards the end of their life, whether it's donating to charities or helping out their kids. So that's something else you need to put together. So considering all these factors and all these points, whatever the case, your retirement plan should make sure you have enough funds to take care of all the different situations. And whether you want to manage that yourself or use the services of a financial planner, it's really up to you. Okay, and now we get to probably the most popular question I get all the time in these seminars about retirement, which is, how much do I need to save? Everybody asks that question. Everybody wants to know. You've probably seen in the media and newspapers a standard that's been around for a while, which is a 70% of your income. For an example, if you think of the 70% guideline, if you're making $70,000, 70% of that would be $49,000. So that was sort of the rule of thumb. If I make $70,000, I need $49,000 in retirement. And that may have been true many years ago, but with the way things are today, that's not necessarily true. And when I tell people the answer to how much you need to save, they sometimes don't like it, but you need to save the amount that you're going to actually spend. Sounds kind of obvious, but that's really what it is. What are you going to do in retirement? This is why it's so important to know what you do in retirement versus before you can actually determine how much you need to save. Are you going to live in the city? Are you going to live in Toronto and Vancouver? A little more expensive. Are you going to live in the country? Are you buying a cottage? Are you going to travel to Europe? What are your interests? If you're going to volunteer and maybe read, it's a lot less expensive than if you're going to travel around the world, take new courses and so on. What about your legacy needs? Do you want to have a bunch of money saved to give to charity or to your family? Again, all of these are going to make a difference on how much you need to save. So it's not necessarily 70%. It's really how much you need to put in what you plan to do in retirement. There's a good calculator and tool you can use on the Canada Revenue Agency website. It allows you to walk through several modules. You put in a lot of information about that'll help you determine then how much do you need. And I'll give you that website at the end of the seminar as part of our tools and resources section. Okay, so to ensure obviously that you have the retirement savings and the retirement income you need to put in a retirement savings strategy, and you need to implement one. CPA recommends the best time to do it, of course, is the first day you started working. Now, of course, for some of those that haven't put one in place, the second best time is today. So it's never too late, in other words. So here are some options. If you haven't put one in place or whether you have one in place, if you want to retire, you may have to increase your income or lower your expenses while you're working. You may have to work a little longer, retire later. And I've seen this with a lot of people. They actually do want to do this. They don't want to retire early. They'd like to work a little longer, but maybe in a different job, maybe not as high as income. But this whole idea of working longer is not necessarily a bad one for a lot of people. To put all this in place, though, it's sometimes good to work with a retirement planner who puts in what I call a financial plan for the rest of your life. We can call it a retirement plan. And this will help you determine how much you saved so far, how much more you need to save, and certainly what kind of savings do you need to match the retirement expenses you're going to have. And for some, of course, this means that there may be a need to adjust your sort of goals and dreams in retirement. Some may need to take on additional debt in retirement, such as a reverse mortgage. This isn't something necessarily that CPA that we find advisable to do. You usually try to make sure you're out of debt as you get into retirement. There are some expenses that may pop up in retirement as well. Of course, while you're working, you tend to be covered for medical insurance through your employer. And when you're retired, you may not have this, so that's an expense you have to account for as well. All of this, of course, is something that a financial planner can help you with as you try to put together a retirement savings plan and a retirement budget. And a retirement planning professional can help you with, in a variety of areas. Obviously, within a retirement savings plan, they can help you identify your retirement savings needs, your risk tolerance, and the use of a lot of tax-efficient savings vehicles such as RSPs and TFSAs. And so now we're going to look at sources of retirement income. This is obviously a pretty busy chart that we have up, but it identifies what I feel are sort of three broad areas of where your retirement savings is going to come from. Your own personal savings and investments, investments that are going to come from the government or government benefits, and of course that come through employers. And we'll talk about all these in more detail, but broadly, if you think of your own personal savings and investments, primarily you're probably used to RSPs and now the newer TFSA product. In government, I think a lot of you know about Canada Pension Plan, Old Age Security, and on the employer side, probably the two of the bigger ones you're familiar with are defined benefit pensions or defined contribution pensions, but there are deferred profit sharing plans, and some of you may be part of a group RSP where you work. So the first source of retirement income we're going to talk about falls under sort of the personal investments and savings, and is known as registered products. And what is a registered product or a registered account? It's an account that is set up with sort of guidelines set up by the federal government. And when you think of registered, it usually means there's a tax structure to it that is either tax deferred or tax enhanced. And in the case of the one we're going to talk about is a registered retirement savings plan, probably something you are all familiar with. It is an account type. It is not a product itself. So under an RSP, you can have a savings account, you can hold GICs, mutual funds, stocks, bonds, lots of different products. So an RSP is not a product, it's an account that has special features set up by the government that allow you to save on a tax-deferred basis until you're ready to retire. There are limits, though, of course, of how much you can contribute to it, which we'll talk about, and there are rules about when you have to start withdrawing from it in your retirement, at which point then you are taxed. There are also a couple special situations where you can withdraw from it without paying tax, and we'll talk about two of those. The first is the home buyer's plan. If there's young people in the crowd, or maybe not young people, you may have done this. We are allowed to withdraw up to a certain amount, in this case $25,000, without paying tax to pay for a down payment on your first home. You do have to pay it back over time, but there is no tax implication of withdrawing that. There's another one called lifelong learning plan. Similar concept. If you find you want to go back to school and you need to pay for tuition, you can withdraw a certain amount tax-free out of your RSP to pay for that education, but then you do have to pay it back over time. So we're going to talk a bit about repaying back two of those programs, the home buyer's plan or the lifelong learning plan. So for the home buyer's plan, it's $25,000 paid back over 15 years or 1/15 each year. If you can't make a payment on any given year, in other words, and a payment in this case is a recontribution back to your RSP, it's just considered taxable income in that year. Same thing with a lifelong learner's plan. It's going to be 10 years you have to pay it back. Same thing if there's a year that you can't make a contribution back into your RSP, it's just considered taxable income. And there are other scenarios of why you may have to withdraw funds from an RSP, not necessarily planned. In the case of bankruptcy, if you lose your home and you need to withdraw funds from your RSP to live, or even pay back your home buyer's plan, you got to realize you still have to pay that back. Bankruptcy does not keep you from having to pay taxes ultimately on an RSP. You can also just withdraw it. Say people lose their jobs and they need to withdraw money from an RSP. It is taxable, so you still have to pay tax at whatever taxable rate you're in at that year. Okay, and let's talk a bit about how the RSP contribution works, the contribution limit, and as everyone likes, the tax refund. Everybody likes to talk about that one. So let's do an example. If you contribute $10,000 of your taxable income for that year into an RSP and your tax rate's 30%, you will get $3,000 of a tax refund that year. Now, big tip on this one, people have to understand, in an RSP, this is a tax deferral. This is not a tax-free. You will pay tax on that at some point when you turn it into what we call a RIF, and I'll talk about that in a few minutes. So do not spend the refund. I know too many people who go on trips and buy things with a refund. Remember, the government's going to tax you on that at some point, so it is simply a deferral. You will owe them at some point, so take that money, put it back into the RSP. Some financial advisors will say, well, if you don't put it at least back into your RSP, pay down high interest debt like a credit card. But what you shouldn't be doing is having it fund your trip down south. Remember, it's a tax deferral, it's not tax-free. So what happens now as you've saved over the years in your RSP? The government, as I mentioned, the government will tax you on that at some point, and the way that works now is that by December 31st, in the year you turn 71, you have to start withdrawing from your RSP. The common product that we use is called a RIF, a Registered Retirement Income Fund. I get people to sort of think about it as a reverse RSP. So instead of putting money in that's tax sheltered, you're taking money out over time, but it's still tax sheltered while it's in the RIF. But when you take it out each year, the government then taxes you on that one. There are rules about how much you have to take out each year. There's a minimum amount each year based on your age that you have to take out. You can take out more if you'd like. and you will be taxed on it, but you have to take out a minimum amount. And your financial institutions have that information if you do happen to have an RSP that you convert to a RIF. It's important, though, on that one then to plan that income out of your RIF along with your other sources of income, because you may have Canada Pension, Old Age Security, you may have a company pension plan, and you've got your RIF. So altogether, that adds up to your retirement income, and you need to plan for that to make sure it lasts you as long as you need. Just give you a couple sort of tips or updates on RIFs. The government recently reduced the percentage you need to take out each year. That just happened recently, so you want to make sure you have the most recent information on what the minimum withdrawal is for your RIF. Another point is when you set up your RIF, you do need to decide whether it's going to be your age or your spouse's age that is used to determine that minimum amount. And people say, well, how does that make a difference? Well, remember, it's based on your age. So obviously the younger you are, the less of a percentage you need to take out. So if someone really does want to take a lot out of their RIF and their spouse is younger than them, then you use your spouse's age when you set up your RIF as the person's age to determine the minimum amount each year. So just a little tip there. And a point on using your spouse's age. Once you make that election, you have to make it at the very beginning of opening the RIF, and you can't change it once you make it. Now, you can withdraw more than that minimum amount each year, but that extra amount is taxed, and you can't use that as part of your minimum for the following year. So it's your option, but just remember you can't allocate that to next year's minimum, say it was part of that. Another personal registered account that is fairly new, it started in 2009, is called the tax-free savings account. Like the RSP, it does have some what I'll call tax features that you need to be aware of, and there are some limits about how much you can contribute in any given year. But it is a great product. Let's talk about how it differs from an RSP. The name kind of says it all. It is a tax-free savings account, which means anything you earn based on your contributions into a tax-free savings account is tax-free. You will never be taxed on that. Now let's differ that from an RSP. RSP, I put in a certain amount of money. The government then gives me a tax refund back saying, oh, I shouldn't have taxed you on that amount. But when you take it out, all of that will be taxed. Tax-free savings account, they don't give you a refund back. It's after-tax money, but anything you earn on it will never be taxed. Now, there is a limit each year. In 2015, it was $10,000. The recent federal election results, it is now going back to $5,500 in 2016. Again, it's something you always want to check with your financial advisor as to what the limit is. But let's just for now say it is at $5,500 going forward for now. And it is something that if you withdraw, you can recontribute the following year. Now remember how in RSP you withdraw and you pay taxes on it. A tax-free savings account, you can take the money out, but you have to then wait at least 1 year, the next calendar year, to recontribute to it. Tax-free savings account, like an RSP, is an account type. It is not a product. So in a tax-free savings account, you can have GICs, a savings account, stocks and bonds, mutual funds, whatever you'd like. Again, it is an account type that has certain features, but it is not a product itself. A little tip about contributing to it. You can contribute to your spouse's or your adult child's TFSA without setting up a special account. So RSP, if you want to contribute to your spouse's, it's called a spousal RSP. It is a specific product. But with TFSA, you don't have to do that. You can just provide funds to your spouse's TFSA. You can provide funds to your adult child's TFSA, and that's totally allowed. Now, condition, you don't have to be employed. You don't have to have certain income like you'd have to do with RSP. You have to be 18 years of age, though, to set up a TFSA in Canada. Now, let's talk a bit about what I'll call non-registered investments. And you know, we use the term registered and non-registered, and people are saying, well, what do you mean by those? A non-registered investment is something that's owned by the individual, but it's not part of a registered product like an RSP or TFSA. In other words, there's not specific tax rules around it or limitations. So think of the most basic. I mean, a lot of you used to own Canada savings bonds, right? Just regular Canada savings bond. That is a non-registered investment. That's, you know, it's not in an RSP if you don't hold it there. And it's like anything, any other product, GIC, equities, stocks and bonds, mutual funds, an annuity from an insurance company, property that you have rental income. These are all considered sort of non-registered investments that you may have and need to be part of your retirement plan. And for some people, it is an important part. I know people who have rental property that they use and they plan to have as part of their retirement income. For a lot of people, the biggest source of retirement income is a non-registered investment, and that's their house. And I know a lot of people who are using that or plan to use that as a big part of their retirement income. So you do need to account for non-registered investments as well. So now we're going to talk about another source of retirement income, and it is really what I refer to as government programs. The most famous, I guess, is Canada Pension Plan or the Quebec Pension Plan, Old Age Security, and for low-income people, the Guaranteed Income Supplement. So let's talk about Canada Pension Plan. It is a pension plan. It is something that you contribute to. You probably noticed on your your payroll statements you are contributing along with your employer to the Canada Pension Plan. It is based on the income level you're at, and there's a minimum and maximum. It is something you do have to apply for. It doesn't come automatically. You can start it as early as age 60, and you can start it as late as age 70. The longer you wait to start collecting it, though, the more you'll get. And this is a recent introduction by the government where it used to be age 65. Got CPP, as we call it, age 65. And the government introduced a way that you can actually get a little bit less the earlier you take it, or you can get more if you defer it till a little bit later. And we're going to talk about a couple specifics about how that works. A couple tips about applying for Canada Pension Plan. You have to apply at least 6 months in advance to start receiving it because it takes some time to put it in place. And you can apply as early as sort of 1 month after your 59th birthday. In other words, 11 months before you turn 60 is when you can start applying. What determines when you should start, though, is a personal one. And we'll get into more details about whether you should start getting Canada Pension at 60 or 70. But it is a personal one, and it's often based on other sources of income you have and maybe your own sort of family history of how long you may live. And I'll get into more details a little bit later. Just a quick comment about Canada Pension contributions. There is a minimum and a maximum amount. So on the minimum side, your net income for any given year has to be at least $3,500 before you start making Canada Pension contributions. And there's a maximum amount as well, roughly around $43,000, that it's capped there. So in other words, if you make more than that, you're not going to continue to pay higher Canada pensions. There's a cap, and you need to at least have $3,500 of net income for the year to make a Canada Pension contribution. And a note around Canada Pension Plan, when you start receiving it from 2012 to 2016, the government has changed what your benefit is depending on the year you start taking it. So for example, if you take an early pension, there's something called an early pension reduction. It's anywhere from 0.5% to 0.6% for each month you receive it prior to age 65. So for example, if you took it as early as age 60, you would get 36% less than you would have got if you took it at age 65. On the other side, if you delay taking it past age 65, you get roughly about 0.7% for each month you delay it. So if you wait till age 70, you're going to get roughly 42% more than if you took it at age 65. Now, we have an example from Service Canada, from the Canada Revenue Agency on an example. So we have Amrita. She's a nurse. She plans to retire at age 65. And that is the normal age. So based on her current Canada Pension statement of contributions, she'll get roughly $6,200 annually. And this amount is obviously indexed to Canada Price, Consumer Price Index, and it'll grow over time. Now, let's say she delays taking her Canada Pension until she reaches age 66, so 1 year. She'll get roughly 8.4% more by doing this, which is roughly about $500. And this, again, also is indexed to the Canada Consumer Price Index. So that's an example of someone who just delays it by 1 year. They get roughly 8% more. Now, quick update on delaying it. Of course, there is no benefit delaying it after age 70. That is the maximum amount you're going to get more, 42% more. But you're not going to get any more beyond that. So start claiming it by age 70. And remember, the government isn't going to necessarily remind you you have to apply for CPP. So make sure you do that at some point between age 60 and age 70. So what about people who decide to take Canada Pension Plan at age 60 but continue working? As I mentioned earlier, a lot of people decide to continue working, maybe in a different job, in retirement. But you also now can start to take Canada Pension. Previously, you had to stop working before you can apply and take Canada Pension. But the new rules are you can continue to work and take Canada Pension at the same time. But there are a couple things you need to know about. One is called the post-retirement benefit. So if you're between age 60 and 70 and you're continuing to work, but you're taking Canada Pension Plan, you need to keep paying into it. Now, you're not paying into what I'll call the core Canada Pension. You're paying into what I call the post-retirement benefit. And it's mandatory up to age 65 if you're working. Beyond that, so let's say you want to continue working when you're 66 up to 70, it's optional. You don't have to contribute. You can and keep building up your post-retirement benefit. And what that means is then, in theory, you could have sort of two benefits by the time you're 70 if you continue to work. You'd have your regular Canada pension, say you started at age 60, and now you're going to have this post-retirement benefit that also kicks in as well. A little more complex. Key thing to remember though is you can retire or not retire and start taking CPP, but you have to decide after age 65 whether you continue paying into it. Before 65, you have to, and it's part of the post-retirement benefit. So to summarize all those options, if you start taking Canada Pension Plan at age 60, but you continue to work, up to 65, you have to be part of the post-retirement plan. After that, it's optional, and then by 70, contributions have to stop. And a final twist on the whole post-retirement benefit, if you started taking your Canada Pension Plan, say in Ontario or another province, but then you moved to Quebec and started working, now your post-retirement benefit or supplement is going to come from the Quebec pension plan. Your regular pension plan is still going to be CPP, so you need to understand it if you move into Quebec and start working there after you start taking CPP. Now, and here comes the big question I get asked a lot, and a lot of advisors get asked, which is, of course, when should I take my Canada Pension Plan? Because now the government gives you a choice, age 60 or as late as 70, as opposed to the mandated 65. So now people want to know, well, what should I consider when I do it? And the answer, of course, is it depends on your own personal situation. What is your age at retirement? If you are going to retire at age 60, you may need the money. You may need the funds in addition to your own retirement savings, so you would be taking it earlier. You also want to consider how much have you contributed and how long have you been contributing it to it. So if you haven't been working a lot or you've been out of the workforce, you may want to actually defer that so you can get more of it if you, say, wait to age 70. What are your other personal savings? You may have actually saved a lot through an RSP or a company pension plan, and you don't need CPP early. And you can afford to delay that so you can actually get the larger amount if you wait to, say, age 70. What's your retirement lifestyle? Again, if you need the money earlier on because your retirement lifestyle requires you additional funds, then you may want to do it a little bit earlier. Health, now this is an interesting one. People will say, why does health matter? Well, remember now, the way Canada Pension works is you start getting your Canada Pension Plan when you pass away, other than the survivor benefit, it stops. So if I think I'm going to live to 100, I'm going to live a long time, someone may say, oh, wait a minute, I'm going to live a long time, I'm waiting to age 70 before I start collecting. If you're in poor health and maybe the men in your family never live past the age of 75, you may want to start collecting it earlier so you have more years of collecting it. Again, it's not a simple decision. It's one that needs to be done in the context of a bigger financial plan, and it's one I always encourage people to work with their financial planner to determine when the best age for you is to start receiving CPP. Now remember, your financial planner will look at all of your sources of income and help you determine whether you should take it earlier or later, such as your own personal savings, your other retirement income, and whether other income you may have, such as business investments, rental income, and so on. Now, another familiar government program you may be aware of, in addition to Canada Pension Plan, is Old Age Security. Old Age Security is a little bit different than Canada Pension Plan. It is a monthly payment. It is indexed to inflation, but you didn't have to pay into it like you did with Canada Pension. It is one that is based on you having residency in Canada. To get the full entitlement, if you were in Canada after the age of 18 for 40 years, you'll get the full Old Age Security. But it is more of an entitlement than it is a pension, and so that's how it differs from Canada Pension Plan. Now remember, Old Age Security starts at age 65, but unlike Canada Pension Plan, it doesn't matter whether you've been working or not. And a couple specifics and sort of highlights on Old Age Security now. Like CPP, you have to apply for it, in this case at least 6 months in advance, because it does take time for receiving your payments. They do have a proactive enrollment that is being phased in right now between 2013 and 2016 for seniors, so they don't have to complete an application anymore. They get notified by mail. And as of 2012, the federal government has introduced a gradual increase in the age that you'd start Old Age Security from 65 to 67. So that's a change. So in general, if you're born after 1963, you'll start receiving your benefits at age 67 or older. And those born between 1957 and 1963, consult the Service Canada website to see the specific time that you would start receiving it. And Old Age Security now can be deferred, similar to CPP, if you're working past the age of 65, and as a result, you'll see an increase in your benefit payments from Old Age Security. And one more tip around deferring your Old Age Security. You can defer receiving it up to 60 months or 5 years after the date you become eligible for it, in exchange, obviously, for a higher monthly amount. And similar to Canada Pension Plan in the decision of whether I should take it earlier or whether I should defer, it's the same concept. You want to consider your other sources of income, what your retirement spending needs are, whether it makes sense for you to defer it longer. Now, a couple things you need to understand. It doesn't pay to defer it past 70, like CPP, because you won't get more after that point, so at least take it by age 70. Another difference, though, is old age security has something called the clawback, and you've probably seen this in the newspapers. Canada Pension is obviously taxable income, and you pay it based on your income for that year when you're retired. Same thing with old age security, but there is a clawback. There's a certain income level that once you reach, the old age security benefit will go to zero. So it's not quite the same as Canada Pension. Now that amount is based on your own taxable income and your own situation. So what I usually tell people is to see their own tax accountant or their own financial planner to get a sense of will they be subject to the old age security clawback or reduction based on their taxable income. That's an important difference between the Canada Pension Plan. And similar to Canada Pension in terms of when to apply, you can apply up to 11 months before you're eligible for it. So let's say you're eligible for old age security at age 65. You can do it 1 month after your 64th birthday. You can apply for old age security. Something that is sort of on top or additional to the old age security is the guaranteed income supplement. And it was brought in to help low-income Canadians who didn't have other resources for retirement. It provides, again, additional money on top of old age security. You have to apply to get it, and you have to file an annual tax return showing obviously for eligibility. A couple more tips around the guaranteed income supplement. You obviously have to be receiving old age security to get it. It also follows the same changes that are happening with old age security in terms of the timing of moving from age 65 to 67. And one additional thing, you do have to fill out a form each year to reestablish your eligibility for it. Now let's talk about another area of, remember we talked about your own personal savings, RSP, TFSA. We talked about the government benefits, CPP, old age security, guaranteed income supplement. Let's talk about the third area, which of course is employee benefits or employee pensions. And let's talk about the different types of pensions. The first is a defined benefit pension. And it is what it says. It is a defined benefit based on contributions most likely by the employer, maybe by you. In some places it's you don't have to contribute to a defined benefit plan. But what it is, it defines the benefit. So you'll receive a statement that says when you retire at age 65, you will get X dollars a month for the rest of your life from your company pension plan. That's a defined benefit plan. Defined contribution is a little different. What they define is the percentage of your salary that you're going to put in sort of each pay, and that's sort of your choice. Now there's usually matching. So let's do an example where you put in 6% of your pay, the company says we'll match 50% of that. So we'll put in 3%. So a total of 9% goes into a defined contribution plan, and it goes into various investment funds. Key point to remember though, and this is where I tell everybody, don't pass up on that matching. It is, I call it free money. Nowhere else can you go where you will have an investment that gives you a 50% return automatically. So make sure you take advantage of it. Let's do an example where you're putting in $3,000 a year. Say the company's matching it a third, they're putting in $1,000. Never pass up on that opportunity on your defined contribution plan. It is a benefit the company's providing you. A couple other ones, there's a deferred profit sharing plan. Similar to, you may get bonuses, annual bonuses that you get each year. Well, some companies take that bonus and they really put it into a deferred plan. And it's kind of like an RSP where it's deferred. You don't pay taxes on it. When you finally take it out, you do. So that's just called deferred profit sharing. I call it like, it's a bonus, but you really don't get it right now. You have to sort of leave it until you retire. And then there's group RSP. A group RSP is really what it sounds like. It is an RSP. You just don't open it up individually. It's part of a group plan. And it usually benefits, there's usually some benefits to it that the company negotiates very low management fees on the mutual funds, with the provider and so on. But it is and acts very much like a regular RSP, and there may or may not be matching. Usually there isn't matching. But key point is take advantage of your employee benefit all the time. Too many Canadians are not taking advantage of the matching they get at their employer with their defined contribution plan, and you're really walking away from free money. Now, a point to make, I know we've talked about employee pensions, but I think it's really, really important to know, and this number is declining. Right now, roughly only 40% of Canadians have a pension, and this is a number that's being reduced. We rarely see now defined benefit plans. Maybe at most you see defined contribution, but it's very important to understand that a lot of Canadians don't have a company pension. So they're going to rely, and it's very important, on their own savings, and obviously some assistance through the government programs. But if you have an employee pension plan, you're part of the lucky 40%, so make sure you take advantage of the matching that they provide you on their defined contribution plan. Now, we've covered obviously a lot of ground today about why you should plan for retirement, all the various ways to save for retirement, where retirement income comes from. So a lot of material covered, but I remember I told you I wanted to leave you with sort of 10 things to remember about retirement planning, and I'm going to walk through them now. The first one, of course, and this is I've seen myself, I have retirement clients, so if you plan wisely, retirement is, and it can be, but I think it is, one of the best periods and rewarding and fulfilling stages of your life, and I've seen this. Retirement can be a wonderful time of your life if you plan for it. So very important concept. Remember, you're part of a generation now that is going to be the healthiest and the longest living population ever. So for those who are younger in the audience, you will live maybe 100, 110, maybe even more. So remember now, retirement used to be this long, now retirement can potentially be that long. An important thing to remember. Also remember that government payments or government benefit programs, while they're important, and it's obviously a good feature of Canada, they aren't enough to fund your retirement. So it's important that you do consider either your own retirement saving strategy and certainly take advantage of ones that come through your employer. Non-registered investments, again, anything that's, we usually just talk about RSP and TFSA, but remember, non-registered investments should also be part of your retirement plan, and that's through your own personal savings accounts, rental property, your home, and so on. So it's part of the bigger picture as well. How much wealth you need. Again, remember the question we asked, how much do I need to retire? Again, the important part to consider, it's part of your overall goals and dreams, or as I put it, what are you going to do in retirement? That's the most important thing to think about. Then that'll tell you how much wealth that you need to fund that retirement. Number 6, the next one, of course, make sure it's a realistic plan. I know sometimes television commercials show this exciting in Tuscany or Provence or so on. Remember, this needs to be a realistic retirement plan, one that you can actually meet and put a plan in place to make sure you have enough money to do it. So keep it realistic. Certainly take advantage of the government programs for registered products out there. For example, RSP and TFSA, these are great products. They have taxable benefits to them. Take advantage of it. Make sure you understand the difference between the two because there's different times where a TFSA is better than an RSP and vice versa, so make sure you understand them, but certainly take advantage of them. Understand too that on government benefits, in most cases you do have to apply for it. Now I mentioned how we're doing auto enrollment for old age security, but in general it's up to you to make sure you apply for your government benefits when you reach your retirement age. Again, another point we just did recently is take advantage of your company pension plan, specifically a defined contribution plan that has matching. Make sure you take advantage of that free money. It is a return you would not get in any other type of investment, so make sure you take advantage of your company benefit. And then last, make sure you include all your assets in your retirement income. And what do I mean by that? When I sit down with clients and we go over all their assets, they go, okay, here's my RSP, here's things like that, and they don't take into account. They forgot about Canada Pension and Old Age Security because it's not something you see while you're working. They've forgotten about the value of their house. You know, there are other assets you may have, so make sure when you're looking at the big picture of all the sources of retirement savings, you consider all assets that you have, not just the ones that come to mind initially, such as an RSP or a pension. And obviously, we've gone through 10 points that we've identified as important, but it's good to ask the audience if there's other things that they've considered. And you'll find that they tend to have ones that they've thought about as well. So make sure to take some time at this point to actually ask them if there are other points that they want to raise and raise with the other participants. And as I mentioned at the beginning of the presentation and the agenda, at the end, we're going to provide you with some tools and resources where you can go on your own afterwards. And the slide shows a variety of services and publications and so on that you can get from some of the government websites that'll help you as well as part of your retirement planning. So at this point in the presentation, you would probably open up the floor to questions. Now, you probably got some earlier on as well. Now, remember, this is a pretty technical subject. People will have some very specific questions. They'll say, well, I've been in Canada for 20 years, so how much old age security do I get? Or I have this defined benefit plan, what does that mean? You're going to get a lot of technical questions. Now, to keep the presentation going, usually you'll just tell the person, I'll deal with you one-on-one, or I'll answer that question later on when the presentation's over, because it's usually specific to them. So at this point, I would open it up to just general questions. If someone had a specific one, because you can see them, they have something in their hand and they obviously want to come talk to you, usually I wait till everyone's asked their questions and I remain behind afterwards. Now, Another key thing to do is, depending on how you're registered in your province and what you're allowed to do, there are some things you cannot tell them. So they may ask you a question about the taxable impact of something. If you're not registered as a tax accountant, you have to be careful. So I usually qualify any answer I give. Usually tell them, see their own financial advisor or their own tax accountant afterwards, because you want to make sure they need to follow up with the proper person afterwards, just for your own practice. So thank you, everybody. I hope you enjoyed it. It was, I know, a lot. There's a lot more to retirement than a lot of people think. I know when you're working, you have usually one source of income. You have your salary. When you retire, now you can have 5, 6, 7 sources of income, and you have to apply for benefits, and you have to do this. So it's complicated. So what I want to leave with you is that, first of all, most studies have shown that retirement is sometimes the best part of your life, best time of your life. So look forward to it. 2, make sure you plan for it, because there's a lot to think about. And I would always say, get professional help. Get an advisor, get a retirement planner to help you through this. Otherwise, thank you for coming today, and I hope you enjoyed it.